Welcome to the InterMarket Analysis video update. This is a weekly video where I look at a number of different things. The first area that I look at is the valuation of the S&P, both on a historical basis and on a forward-looking basis, to see is the market considered to be expensive, fairly priced, or inexpensive. Then I go through a pretty extensive study of growth versus value. When growth is outperforming value, the market tends to do really well. And that's what we want to see in a more positive environment. If value is starting to overtake growth, that could suggest that the market's becoming more defensive and getting ready to go down. Then we look at a number of different markets outside of the S&P. We look at other indexes, we look at other sectors, we even look at completely different markets just to keep an eye on different areas of the total market picture to see, can we get any clues as to what's happening ultimately within the S&P 500. This is being prepared for Tuesday, January 21st. The first area is valuation. And what you see here is based on past earnings that have been released and then comparing them with price. And this creates a PE ratio, a price to earnings ratio. When this ratio gets really high, stocks are considered to be quite expensive at that point. When it's low, they're considered to be inexpensive. You can see on this chart where we have a PE ratio of 20 here. That's the high level. When we get to 20 or above, stocks are considered expensive. And we've been above this red dashed line now for a number of years. And we tend to be above it a lot because the market is optimistic. And they think, well, if earnings were good before, they're going to continue to be good in the future. The economy seems to be doing okay, so we can justify stocks being considered to be expensive. Down below, this is a breakout of the current price of the S&P compared to the PE ratio of 20. So yes, we are expensive. This also looks at it going back to 1980 and different events that happened and what the valuations were at that time. And you can see that we spend a lot of years above the red dash line. Now, a lot of people freak out over this and say, oh, the market's overvalued. Yeah, it's overvalued, but that doesn't seem to matter. We don't use this as a timing mechanism. We just use this as something to be aware of, more for information. Then Robert Shiller, who's a very famous economist and has written some books, came up with a variation of the PE ratio called the Shiller PE ratio. And he takes a more smooth approach looking at earnings over a period of time. And you may hear this referred to as CAPE, CAPE, or just PE 10, because he usually uses 10 periods, 10 years of earnings to get more of an average. And right now, the reading that he's coming up with is 38.11. Okay, and you can see over the course of time, this is a pretty high reading. Then we also look at the median and the mean, which is between 16 and 17, and the current price is 38. So yeah, we're over double, looking expensive. But again, we've been seeing this now for a number of years, and so we don't use it to make decisions necessarily. We just use it as part of our information in the market. Now, Edward Yardeni, who's another respected economist, he plots forward-looking PE ratios because that's really what the market works off of. And we also use that 10, 15, 20 scale to see if we're inexpensive, fairly priced, or overvalued. And right now, the purple area, these are the mega cap 8, the real high-flying stocks, the ones you always hear about, the ones that do most of the volume every day, and they have the most impact on the indexes. Their PE ratio is coming in at 29.8. We're well above that 20 level, but folks don't seem to mind. As long as the earnings look good going forward, they don't mind being involved in a stock that's already expensive as long as it gets more expensive because that means it's going up in price. What I pay attention to is the red line here. These are forward-looking earnings for the S&P 500. It's also above that 20 level. It comes down. This tends to come down when the market is going down. And even though it has come down, we're still above that 20 level. So we're considered to be expensive here, but we've been expensive. We've been above this 20 level for most of 2024 and now going into 2025. What's more fairly priced right now are the mid caps and the small caps, and that's the green line and the blue line, where we have the mid caps coming in at 16.3, right about that 15-ish level for fairly priced, and small caps are at 15.8. They're coming in lowest, but then you have to look under the surface and say, okay, small caps look fairly priced. They might be able to go up. Are there the earnings behind these small cap companies to justify producing a higher PE ratio? Okay, then I go through and look at growth versus value. And what we're looking for here is just a confirmation across the board. I look at growth by itself, like in this chart, where we are in an uptrend here. We also look at value, which is in an uptrend, but it's been lagging behind some. And then where we really get some insight is when we look at ratios between the two. And we want to see this with all the charts coming after this. Is growth outperforming value? Yes, it is. And then here's an inverse. Value is underperforming growth. Okay, we like that. Here's an ETF. Growth is outperforming value here. Another confirmation. Value is underperforming growth. Yet another confirmation. The indexes on a longer term look here, showing growth is outperforming value. This shows on a shorter term basis how value is underperforming growth. So we're seeing a confirmation. And then one more here, also showing how growth continues to outperform value. Then, actually, there's a few more. We look at a growth ETF and compare it with a value ETF, and we are coming down into the rainbow. This had been a lot stronger. We're not necessarily turning over negative here, but we have been seeing a pullback as the S&P was underweight. And this week that we just finished actually saw value outperforming growth. Now, it's okay because when stocks are going up, that's positive. But when this really goes up, that's when the big mega cap stocks, the growth stocks, they're really outperforming. And that's what we want to see in a more positive environment. So if we're going to switch over and be more positive, we want to see this ratio starting to go back up. And then value underperforming growth, even though it has been bouncing back up so far in 2025. Then we break it out a little bit more. We look at the small caps. Everybody is hoping, right? Not everybody, but most people are hoping that small caps are really going to go up. Is this finally it? Because about the time we thought that small caps should do well, they just kept going down, 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 down. And then they went sideways for a while, then they dropped a little bit lower. We're still kind of just a little bit above this range that we've been in for a while. So the index hasn't really switched over and looked positive yet. But when we look at the growth to value ratio, this is in an uptrend and actually holding up quite well. So this could be under the surface, showing that the smart money is coming in and buying small cap growth stocks. And that's why this ratio goes up. And that could be positive. And we're seeing a very similar thing here with the mid caps. The ratio is looking pretty good. We're just waiting to see, can the index now follow through and have some upside momentum? S&P growth to value. This is the one I focus on the most. This is in an uptrend, looking good right now. And this has been more in line. When this is going up, we tend to see the S&P going up as well. We want to keep an eye on inflation, and this is a long-term chart of the CRB index. Those are commodities, and we're starting to go back up. Commodities have been rising, and that can be inflationary. That can cause some concern to the markets. And this past week, the market seems to have settled down with that idea that, oh my gosh, these economic reports that are coming out, they're stronger than expected. The Fed has come out and said they're going to pause cutting rates. Well, these reports are so strong, they may have to come in and actually raise rates. Well, with PPI, CPI coming out, even retail sales this past week, they weren't, they were still up, but they weren't as bad as the market was afraid they were going to be. And that's why we saw stocks really going up, at least later in the week. Well, we want to keep an eye on this because we are starting to go back up with the CRB index. And this is long term. This is a monthly chart. Now, we also look at a ratio down below, the inflationary areas of the CRB index versus the deflationary areas of the CRB. And even though this is ticking back up right now, we still see the moving average continuing to go lower. So longer term, we're a little bit concerned here. because usually when you see economic growth, you also see inflation. So what we're trying to do is find that Goldilocks era where the overall economy is doing well and growing. That helps stocks to have better earnings, but we don't want inflation to be out of hand because inflation means interest rates are going up. Now, interest rates going up does not necessarily mean stocks are going to go down. Lately, it has. It's more in the short term, but longer term, interest rates can go up and the stock market can go up at the same time. It's just when they get out of line with each other, that's when we get concerned. All right, then we look at another daily chart of just the CRB index where it's been going up lately and it's in an uptrend right now. We also look at the Baltic Dry Index. This really hasn't been all that helpful lately, but as a general rule, this is how much does it cost to ship products, specifically in the Baltics. And when this is going up, that's more inflationary. When this is going down, that tends to be deflationary. And we're actually still going down. We're chopping around with the latest reading in this chart. Then the market has inflation expectations, and they have been going up lately. It's just what does the market think is going to happen as far as inflation? And going into the latter part of 2024 and into early 2025, this had been going up. It did fall back a little bit this past week. This is a weekly chart. All right, then we look at some other markets just to see, okay, is anything really weird happening here that can have an impact on stocks? Aluminum is in an uptrend, but it has been pulling back. We look at corn, which is now starting to go in an uptrend, and wheat, which is still in a downtrend. We keep an eye on fertilizer because that's a real foundational part of farming, where it has been going up lately, but it's not really screeching higher, at least yet. Oil, we watch this, not only is it going up or down, that can be inflationary or deflationary, but this can really start to gyrate due to geopolitical things going on. We spent quite a bit of time down around the 70 level. Well, now we're starting to get up into the higher 70s right now. So we want to keep an eye on this one. We look at the ratio between gold to oil. Well, gold has been under pressure, and that's why we're seeing, at best, it's been going sideways. And oil has been going up, so that's why we're seeing this ratio going down. And then we look at a correlation. In red, this is oil, where it had been going up, and then recently it pulled back. And then we look at the 10-year yield here, which had been going up and is also pulling back. But right now, the correlation between the two, this is neutral. When we're at 0.25 and above, they're going in the same basic direction. When we get down to minus 0.25 and below, they're going in opposite directions. When they're in this middle area, it's more or less neutral. Keep an eye on gas, it's still in an overall downtrend, but it has been coming back up. Heating oil also bouncing back up, but still in a downtrend. Natural gas is starting to go over into an uptrend right now. And we want to keep an eye on diesel, which is spiking up a little bit now. And this could be potentially inflationary because 18-wheelers, trains, that's what they use. And this had been coming down for the most part. So we'll see if this continues to go up. That might be a concern to the markets. We keep an eye on copper. This is one of the different barometers that I look at. There's another one that I'll show later. And as a general rule, when copper is doing well, that means that the economy is looking good going out into the future. We have been bouncing back up here, but we're still in a downtrend here on the daily chart. And we look at a copper to gold ratio, which still shows that copper is underperforming gold. Longer term, copper continues to underperform gold. We also plot the 10-year and the 2-year yields here, where they typically go in the same direction. They typically don't get all that far apart from each other, even though they're on different scales. But lately, they have been going in opposite directions as the economy could be shifting over into a new environment. But we've been watching this now for a couple of years. Gold is still above its 50-day moving average and still in an uptrend, but it's really been chopping sideways for the most part. Silver came down to its 200-day moving average, was able to get back above that, but now currently it's underneath its 50-day moving average. And if we see more weakness below this blue line here, this could actually change into a death cross at some point as far as the longer term trend. Then we look at the closing price for gold on top, the closing price for silver in the middle area, and then do a correlation between the two. and they have a pretty strong correlated relationship right now, meaning they're going in the same direction at the same time. Then we look at a gold to silver ratio on top, and then we plot the US dollar index in the middle. And quite often we can see a pretty strong correlation between the top chart and the middle chart. Just to give us some insight, the interaction between precious metals and currencies, specifically the dollar. Well, this relationship is actually coming down right now, and it's not quite neutral, but it is dropping closer to that neutral area. We want to keep an eye on the dollar. It's really been strong lately. It got up on an intraday basis above 110, but on a closing basis, it never got there on a closing level anyway. We're still in the 109 range, and this can pressure stocks because most S&P 500 companies do business internationally. And so they're taking in money from other countries. They're converting that over into dollars, and then that goes on their books. And when the dollar is weaker, the conversion rate gives them more dollars if the other currency is stronger. And so a stronger dollar means there's less dollars. And so that's not as good on an accounting basis for their bottom line. Also, because they do international business, there's import-export relationships that go on that tend to favor these S&P 500 companies when the dollar is weaker. Then we plot the euro, which has really been going down lately as the dollar's been going up. And then we look at the Japanese yen, the euro, and the US dollar here, all on one chart. These are the three main currencies. Now, there's all kinds of currencies out there, but the big players in the financial markets are these three right here. And then we break them out and we show that the euro is in a downtrend when compared to the dollar, and they're getting kind of close to par here. So this might be a good time to consider a vacation to Europe. We also look at the Japanese yen, which is in a downtrend compared to the dollar, and the British pound is also in a downtrend compared to the dollar. All right, then we're looking here at the equal weight version of the S&P 500. That's the red line, which has been improving lately. And then the regular S&P 500, which is a weighted index. And when this red line's coming down, that means that the rest of the stocks that make up the S&P are underperforming the really big stocks. Well, this is improving right now, and they're getting a little closer to each other. Yes, they're on different scales here, but when we see a real upward movement like we saw last fall, where the red line and the bar chart were pretty close to each other, that means the whole market is participating more in an up move. Just like when we were going down, we saw the equal weight stocks, the stocks that aren't as influential in how the S&P is calculated, they were underperforming as everything was going down. We could be seeing a bit of an improvement here. And we look at a ratio between the two. When this is going down, that means the equal weight is underperforming the weighted version of the S&P 500, and it's bouncing back up a little bit. As in Friday's session, the equal weight actually did better, and it did better for the week as well. We look at a ratio between stocks and commodities, been coming down now, but we're still in an uptrend, showing that stocks are outperforming commodities. But commodities have been strong, where stocks are still potentially coming out of a weaker time. And so that's why we're seeing this ratio going down. And this also shows how commodities longer term are underperforming stocks, but have been rebounding lately. We look at the NASDAQ 100, which has done really well over the last few years, and the S&P 500, which has also done well. This shows that the NASDAQ 100 is outperforming the S&P. That means that the bigger stocks that make up the market, the NASDAQ 100, these are tech stocks, they're doing better. Now, the stocks that are in the NASDAQ 100 are also in the S&P 500. So to see both of these doing well, we like that. And the S&P 100, it came all the way down to its 200-day moving average and possibly bouncing up off of this. The S&P 100 are the bigger stocks that make up the S&P 500. And this is in an uptrend, but we came all the way down here. If this had dropped below the red line, that would be more negative. If this continues to go up, that'll be more positive for the S&P 500. The NASDAQ compared to the S&P 500 shows that the tech stocks, because that's really what the NASDAQ is, they're outperforming the S&P, even though both have been doing well by themselves. The NASDAQ 100, though, is still underperforming the rest of the NASDAQ, which is not what we saw in 2023. Now, this is not really a big cause for alarm. This is actually probably considered more positive since it's not just a few stocks that are driving the market higher, it's more participation here, meaning that the rest of the NASDAQ is outperforming the specific NASDAQ 100 stocks. And the mega caps, these are the real big stocks compared to the equal weight version. When this is going up, the mega caps are outperforming. We came down and got close to the 50-day moving average with this ratio. It's going to be more positive if we see this ratio start to go back up. That will help the S&P to go up. Small caps, though, even though they're supposed to be at the moon by now and beyond, they're still underperforming for the most part. They've got a lot of work to do. They need to get above both these lines here, which is a 50-day and 200-day moving average. We need to see the blue line cross above the red line and then see that last a while. That would show that small caps are starting to outperform. This also shows that same ratio, which is in red, and the blue is the S&P 500, how they've been going in opposite directions. Then we look at what's called traditional Dow theory. This was developed by Charles Dow, who was also, I think, founded the Wall Street Journal a long time ago. And basically, what we're looking at is how is the Dow doing by itself and the transports? If the Dow is making a new high, are the transports making a new high? Are they confirming each other? And even if both have been under some pressure lately, and in Friday's session anyway, the Dow went up where the transports actually went down. Now, I also include utilities as part of traditional Dow theory, but not everybody will do that. Where utilities were really strong, but now they've been coming back down, but they did bounce back up over this past week. We're just looking for any confirmations here or divergences, either positive or negative. We're not really seeing all that much right now. We keep an eye on the advanced decline line, and this is still negative for the most part, but it is improving. It's actually turning a little bit positive for the S&P and the mid caps. When it's positive is when we come back and go above the moving average that we have here, where we're back up to the moving average with the NYSE when you just look at common stock. And small caps are improving, but they're still underneath the moving average. Mega cap growth, this is all by itself. It had been pulling back. It came down to its 50-day moving average and is now starting to come back above that. That's positive for right now. The robotics and AI ETF, it's just been chopping more or less sideways. This is all the buzz. This is what everybody's all crazy about, but we're not really breaking out to the upside right now. Now, earlier in 2024, we were doing really well here, and we're still at the top end of the rainbow, but we're not really going up with any real conviction. And when we compare it to the tech sector, it's actually underperforming. Now, it did bounce up here in Friday's session, but you look at these longer term trend lines here, and it shows that the robotics and AI ETF has actually been underperforming the tech sector. The Dow Jones Composite Average, which does take the Dow, the transports, and the utilities and puts them together, had fallen below their 50-day moving average. They're still under the 50-day moving average. If they can recapture that, that's going to turn things more positive. We look at a ratio of the Dow to the transports. When this is going up, the Dow's outperforming. When this is going down, the transports are outperforming. And for most of 2024, the transports have been pretty disappointing here. And we're seeing an overall uptrend as the transports just really haven't been performing as well as a lot of people had hoped. These are the transports by themselves, and we pretty much have been sideways. We did break out and set an all-time high, but then we came right back down, and we're back in this range that we've been in over the last few years. We look at a ratio of the transports to the S&P, and this is going down. That means the transports are underperforming. And then we chop sideways, broke lower. We're trying to show an improvement now, but it's been dropping back, at least in this past week. We look at the correlation between the S&P 500 and the Dow transports, and it'd come all the way down to this zero level, so it was pretty much neutral. It's starting to get a little bit stronger again. So if the S&P can go up and this relationship gets stronger, that could push the transports up as well. Then we'd use a variation of Dow theory where instead of using the Dow, we use the S&P 500. And instead of using the transports, we use the NASDAQ. Not really setting any kind of all-time highs here. We are improving at this point. What we're waiting to see is if we do set an all-time high with the S&P, is that confirmed by the NASDAQ? Then we break this down a little bit further, where instead of looking at the S&P, we look at the equal weight version of the S&P, which is starting to show some improvement. And instead of using the whole NASDAQ, we just use an equal weight version of the NASDAQ 100, which is the QQQs. This is also showing some improvement right now, but not really seeing anything that's causing an alarm. The FANG index, this is another way of looking at the mega caps, the really big companies. And this was encouraging, and I was bringing this up in the daily videos, where even when we were under pressure, the 50-day moving average still held for this index. And now we've been bouncing up off of that. If we can continue to go up more, that will be even more positive. And longer term, though, we held up above this longer term trend line here. We've been having a difficult time breaking above this shorter term trend line, but this level held up for the time being. Can we stay above that and go up and possibly test this upper trend line again? ARC, which is a very popular ETF that a lot of people are into, it's still above its 50-day moving average and in an uptrend. Then we look at all the stocks in the world, excluding US stocks. They're not doing so well right now. They're actually seeing just about getting ready to see a death cross here, dropping below its 200-day moving average. But when you compare it to US stocks are clearly outperforming here. So this is the strongest place to be for right now. The Wilshire, this was causing some concerns because we had dropped below the 50-day moving average. Well, we were able to get back above that on Friday. This is showing that the broader market is turning back more positive. And we're also seeing that with the total US stock ETF. We had lost the 50-day moving average. Well, we've been able to get that back. So that is turning things more positive as well. Low volatility stocks, which folks tend to get into when they're more defensive. It's not that low volatility stocks will not go down in a downtrend. They just go down less. And these are more defensive areas of the market. And for 2024, we were in a really solid uptrend here. And I kept bringing this up in the daily videos, but it really didn't turn into much. And that's okay. I would rather watch things that don't develop into something rather than missing something and saying, I wish I would have seen that before. But we did come all the way down to the 200-day moving average, and we're starting to bounce back up, which anytime, no matter what part of the market it is, that can end up being positive. But we want to compare this to the S&P, and that's what this ratio does. We're still going down, meaning that even though low volatility stocks have been in a long-term uptrend, they're underperforming the S&P itself. So the market is not necessarily getting more defensive, at least right now. We look at small caps and compare them to the tech sector, chopping more or less sideways right now. We're in a little bit of an uptrend here. We'll have to see if small caps can continue to go up, because we've been faked out a lot over the last year. If this ratio starts to go up and outperform the tech sector, well, that just means small caps are doing better. But for the most part, small caps have been underperforming. Then we look at a long-term chart. This is a monthly chart of a ratio of US to world stocks, showing that on a longer-term monthly chart, we're still really outperforming here, and the momentum is also going up. So the US market is still the strongest market. All right, then we look at bonds here. And this is really what's been pushing stocks down and putting them under pressure lately is interest rates going up. Now, when interest rates go up, the price of the 7 to 10-year bond ETF goes down, but it is starting to bounce back up here. We are just setting a recent death cross with bonds based on price here. But in the short term, the momentum has switched back to positive, and we're potentially starting to get back above 50 with the RSI. We're also keeping an eye on the total bond ETF, and I've been watching this, and this is something that we were hoping would hold here, that we would hold at the 200-day moving average. We didn't. We actually dropped down below, and that's when interest rates were going up. Well, this past week, interest rates, for the most part, declined, and so we're coming back up to the 200-day moving average. If we can continue to go up with this total bond ETF, that means interest rates are going down, and stocks will probably like that. World bonds, though, continue to be in a downtrend. And we look at a monthly chart of a stock to bond ratio. When this is going up, that means stocks are outperforming. This is a daily chart, though, showing how bonds are underperforming stocks. And we look at high yield corporate bonds. You also may know these as junk bonds. These are still holding up quite well. And we look at more conservative bonds or corporate bonds, and we're seeing some weakness here, but possibly starting to bounce back up. We did lose the 200-day moving average here, but we've been trying to get back to it. Now, the longer we stay below both of these lines, we might see a death cross with this, but we haven't seen that at least yet. We look at a ratio between junk bonds and more conservative bonds, and the junk bonds are continuing to outperform. We look at a stock to bond correlation, meaning that bonds based on price and stocks based on price, they're having a real strong tendency to go in the same direction. And that's what we're seeing right now. If interest rates are up, stocks are down. If interest rates are down, stocks are up. Now, this relationship kind of comes and goes during a period of time, but with interest rates going up the way they had been, that had been really having an impact on the market. All right, and we look at the corporate bond index, which dropped below its 200-day moving average. Now it's trying to get back up to the 200-day moving average. And we look at the 10-year yield, which we were keeping an eye on. It got up into the 4.8s and the high 4.8s, not on a closing basis. What we're concerned about is, are we going to get all the way up to this 5% level? Well, so far we've been coming back down, and this coming back down helps stocks this week to go up. And this is a longer term chart here where we're starting to get up into a higher range of interest rates, which changes what we've seen over the last 40 years, where we see a period of lower highs and lower lows with interest rates. This is more normal historically. What we've seen over the last 40 years is not necessarily the norm, it's the exception. And we could be going back into a higher interest rate environment. The 30-year bond, it was getting up to that 5% level, just a little bit underneath it. And now it's starting to come back down. I was including this in the daily video that I do. Now that we're coming back down off of this 5% level, I stopped using that, but I'll still keep an eye on it anyway. Junk bonds have been doing quite well. Folks are willing to get into these even though they're riskier. They're lower rated, so they get a higher yield. And we're still seeing where junk bonds are outperforming more conservative bonds. And here's a daily chart of yields. Over the summer, it was late spring and into the summer, interest rates were really coming down as there was an anticipation that the Fed was going to start cutting rates. They cut rates in September, and then interest rates started to go back up because the bond market's still worried about inflation. Then in December, interest rates started to come back down. That's when stocks, at least the S&P, set another new all-time high. But then going through the rest of December and into January, interest rates have been going back up. They were getting to a high enough level where that was impacting stocks. And so stocks were starting to go down. Well, we could be seeing a change in that here as interest rates have been coming back down. Now, they did come up in Friday's session, but if overall we see this starting to trend down, that would be more positive for stocks. Another thing that we're watching here, this is a weekly chart looking internationally, and we have the US, the UK, and German rates up here. What I'm watching is the red line. This is Japanese rates. Last August, when we had that big down day and the VIX went through the roof and everybody was panicking and saying, oh, it's the end of the world. The Fed needs to come in and do a 1.5% emergency rate cut right now. That lasted, what, a day and a half or so? That's when Japanese rates were starting to go up above 1%. And then they fell back, and everybody said, oh, okay, well, maybe the world isn't ending after all. Well, now we are back above 1% here. And so if these continue to go up, this red line keeps going up, that could produce some problems in Japan, and they own a lot of US bonds. That could produce some selling, which makes interest rates go up, and that may cause some kind of a panic that we were seeing last summer again. So with this red line going up, we just want to keep an eye on this. We look at some ratios between the S&P 500 and short-term bonds. We're coming a little bit up back to the top end of the rainbow now. So this is still holding up for the time being when we look at the relationship between stocks and bonds. And we look at the S&P 1500 and compare it with short-term bonds, still holding up quite well. Another broad market measure, not the S&P 1500, a different index, and then we compare it with further out bonds, 3 to 7 years. This is still holding up for right now. And we look at the tech sector and compare it with 3 to 7 year bonds, not coming out of the rainbow, but not falling apart either. For this to go up, that would be more positive for tech. And we look at another ratio between stocks and the 10-year yield, where stocks have been outperforming, but then as yields were going up, we saw this ratio going down. We haven't come back up to the 200-day moving average here. We're still in an uptrend, but we need to get back above these lines to turn this relationship more positive for stocks. We look at kind of the same thing. We look at 3 to 7 year bonds compared to stocks. When this is going down, that means bonds are underperforming, or you can say it another way, stocks are outperforming. And here's a long-term chart of the long-term bond ETF showing how price still continues to be in a long-term downtrend. And then we look at a ratio between long-term bond prices and the CRB index. It's rolling over, but it's still showing how bonds are outperforming commodities longer term. We look at the volatility of bonds, which is measured by the MOVE index, and then the volatility of stocks measured by the VIX, and we look at the correlation between the two. Now, this doesn't measure direction. This measures volatility between these two markets. And there's a fairly strong correlated relationship between the volatility of each. Then we look at different sectors, and there's 11 sectors that make up the S&P 500. First, we look at a chart of the sector by itself, and then we compare it to the S&P just to see how well it's doing on a ratio basis. Well, materials are now in a downtrend and really have been going down, but lately they've been bouncing back up as the economy is looking a little bit stronger. And so this could be good for materials, but still they haven't gone back to being in an uptrend at least yet. And then we compare it to the S&P where it's really been underperforming, even though it's been bouncing back up lately. Communication, this is a growth area. You want communication to do well if you're positive on the market. Now we're coming back up here, but we still haven't come above the 50-day moving average. And it had been really outperforming the S&P, but lately it's been falling back a little bit. We need this to turn and go back up for this to be more positive. Energy, which is still in an uptrend, believe it or not, because it really started coming down. And then with inflationary fears and energy starts to go back up, we're still in an uptrend here. And we're still in a downtrend, though, when we compare it to the S&P, even though it has been improving quite a bit lately. Financials, we want the financials to do well. The three big areas that I look at are discretionary, communication, and tech. Those are, when those are doing well, the market's doing well. Then the fourth area that we like to keep an eye on are financials. And they had been showing some weakness, and this was causing us some concern as we were dropping under the 50-day moving average. Well, they came out with earnings, at least the banks did, because banks are part of the financial sector. And we're seeing a real improvement here, getting back above its 50-day moving average. And it's still in an uptrend, even though we've been going sideways here when we look at a ratio with the S&P. Industrials also pulling back as there were some concerns about the economy not doing as well. Now it's starting to get back above its 50-day moving average and still in a downtrend here. We just generated a recent death cross with this ratio, but it is improving now. The tech sector, this is the darling. This is what everybody wants to do well. We are still in a longer term uptrend, but we have not reclaimed the 50-day moving average. And we're kind of going sideways because the tech sector has been doing good and the S&P's been doing good. So overall, we're not really seeing the tech sector outperforming. In fact, it's in a downtrend when compared to the S&P. Staples, another defensive area, really strong through most of 2024, pulling back, fell under the the 200-day moving average, but they're still in a longer-term uptrend. But when we compare it to the S&P, also continues to underperform. Real estate, they don't like higher interest rates. Came down here, but loosely was able to hold on to its 200-day moving average, at least to this point, but is really underperforming the S&P. It doesn't like the rates that interest rates have been going up. Utilities were really strong here through most of 2024. They pulled back. Now they've been able to get back above their 50-day moving average. And we just have seen a recent death cross here with this ratio. If this continues to go down, this would just show that utilities are underperforming. If we continue to go up, we might see a golden cross here, meaning that utilities are looking strong again. Okay, then we look at a ratio between the S&P and utilities, and this has been pretty choppy lately. When this is going up, the S&P is outperforming. When this is going down, utilities are outperforming. Healthcare, defensive area, in a downtrend, but coming off of some recent weakness that we've seen, but still really underperforming the S&P on a ratio basis. Discretionary, another growth area. This has been strong. Notice back here in August, this was when the world was ending. This has been the strongest sector since August 5th. We did come down. We started to lose the 50-day moving average, but now we've been bouncing up off of that and doing quite well and actually outperforming the S&P. Semiconductors. And there, in other videos that I do, I look at a lot of different semiconductor indexes. We look at some ETFs, which are in uptrends. We look at the Dow Jones Semiconductor Index, which is in an uptrend. Well, here the SOX index is actually in a downtrend. We have been able to get back above the 200-day moving average, and we've been pretty much chopping sideways here. We need this to do better. When we were really going up into the summer of 2024, the semiconductors were really looking strong. They've been chopping more or less sideways lately. And we look at a ratio between energy and tech, where energy is bouncing back but still underperforming the tech sector. Growth stocks continue to outperform bonds based on price. And the tech sector is bouncing back up a little bit when compared to interest rates. Tech doesn't like the rise in interest rates either because they all this new technology, they've got to borrow a lot of money for that. We're underneath the 200-day moving average here. We're in danger of seeing a death cross. And we look at an inverse of that same thing, showing longer term how interest rates are underperforming the tech sector, but this might be changing unless we see things come in and turn more positive. Discretionary to staples, again, growth versus value. All right, because discretionary, those are the things that make life fun. Areas like Tesla and Amazon are discretionary. And then staples would be toilet paper and toothpaste. And when this is going up, the market is more positive. And this also shows how staples are underperforming discretionary. Gold, which has been doing quite well, but the S&P's been doing well here, just pretty much been chopping sideways with this ratio. Also coming back down as the dollar's been strong. And it's not that gold is weak, it's just gold has been chopping more or less sideways. This is another proxy where I said earlier that I look at copper to see what's the economy looking like. This is the other proxy that I look at. High leverage loans, very risky loans. These continue to be really strong. So this is suggesting that at least the folks that get into this ETF, they're not really anticipating any problems economically. The NYSE didn't quite come down to its 200-day moving average, and we're trying to get back above the 50-day moving average. All stocks coming just a little bit above its 200-day moving average, and this includes US as well as international stocks. Emerging markets having a little bit of problem here, but trying to get back up to their 200-day moving average. The Japanese Nikkei is just hanging out around these all-time highs here, and this red line goes back to the previous all-time high that was set back in 1989. And this big dip that you see here, this was when everything was ending as far as the world as we know it, only to come back and say, ah, just kidding, about a couple days later. These are the micro caps, smaller stocks. They came down almost to their 200-day moving average, but they continue to be in an uptrend. We want to keep an eye on the home builders ETF and compare it to the S&P 500. They're pretty much in lockstep with each other now. They were starting to get out of line here, but they didn't drop to a really low reading. Now there's more equilibrium between the two. Just keeping an eye on Bitcoin, it's finally been able to get back above 100,000. And then I'll probably at the end of January start just including 2025, but this goes back to the beginning of 2024, showing how gold has been the best performing asset, followed by stocks. That's the black line. Oil is red, and the green, that's the dollar. And then bonds continue to be negative based on price. Then this is a longer term oscillator that we look at called the KST, where China's having some problems economically and their market's having some issues now. They're in a downtrend. We've been in a downtrend with emerging markets, also in a downtrend in Europe. We're trying to turn up in Japan. We're possibly trying to improve here with in the US, but we need to see more than what we saw just this past week. Then we look at some correlations. Stocks to the dollar. Strong tendency to go in opposite directions. So if the dollar is strong, that could be pressuring stocks, as I mentioned earlier. Also looking at the correlation between stocks and oil, neutral right now. And then stocks to interest rates, opposite directions. So if interest rates are going up, stocks are probably going down and vice versa. We also look at the tech sector to the 10-year yield, opposite directions right now. And even in the short term, stocks to the 2-year yield going in opposite directions. So that's why I've been really honing in on interest rates lately. Then some long-term charts here. This is a monthly chart of the NYSE. We're still above the moving average. Seeing a little bit of weakness longer term as measured by this momentum oscillator, the Copic curve. This is a daily chart showing the NYSE record high percent index. This has been coming down. We need to see this turn and go back up shorter term to be more positive. Then we look at a monthly chart of the S&P, still looking really solid longer term. Rolling over though a bit here with this momentum oscillator, the percentage price oscillator. And this is a daily chart of the S&P above the moving average, and we look at a relationship longer term of stocks to commodities, where stocks are still outperforming, even though this oscillator is rolling over a little bit. Then another global look, longer term, a monthly chart of the S&P, and then we're starting to go back up here with the KST, a long-term oscillator. Then at the very end, I look at those things that are positive. And my definition of positive, as it applies to this video, is when the 50-day moving average, simple moving average, is above the 200 period simple moving average. And we've got quite a long list. Both growth and value, when you look at them by themselves, the dollar's in an uptrend, commodities are in an uptrend, gold and silver. Silver's getting kind of close there, but it's still in an uptrend. The mega caps, the FANG index, ARC, low volatility when you look at it by itself. Staples are in an uptrend, the Dow Jones Composite Average. Bonds based on price. The only one that's negative based on price longer term with the trend are emerging markets. The tech sector, high leverage loans, that's another proxy for the economy. The Dow, the NYSE, and Wilshire, those are broad market measures. The NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps still in uptrends. All stocks and emerging markets, as well as Bitcoin. Then we have the negative side, and that's when the 50-day moving average is below the 200-day moving average. And copper's, it's really coming back up, but it's still in a downtrend. The euro, the yen, and the British pound when compared to the dollar, which is good if you want to travel, not so good if you're involved in the stock market. The semiconductors, but other indexes and ETFs that we look at are positive. So we're getting some mixed picture signals there. And the world bond index is in a downtrend. So thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. I do them every day, and then I do a weekly video as well. So have a really good weekend, and I will talk to you in the next video.